Welcome to a special edition of RBC's Markets in Motion podcast. Please listen to the end of this podcast for important disclaimers. Today is June 4th, 2024, and we are broadcasting live from the RBC Capital Markets 2024 Global Energy Power and Infrastructure Conference, also informally known as EPIC. I'm really excited to be joined by two of my Road Warrior colleagues, Ben Fisher, who's one of our Midwest equity salespeople specializing in macro, and Amy Wu Silverman, RBC's equity derivative strategist. Today's format is a little bit different from the typical Markets in Motion podcast. We're going to spend the next 15 to 20 minutes having a chat about the big things you need to know from our recent conversations on the outlook for equities. Ben will be our moderator. Now, before we jump into it, a quick reminder that II voting season is open. And if you found our work helpful this year, we hope you'll cast a ballot for me, Lori Calvasina, in the portfolio strategy category. Now let's get into it and over to Ben.
Great. Thanks, Lori, and thanks for having me, though I was hoping this was on video. As I told my kids I'd be on TV, and I bought a new shirt and shave, but probably better for everyone that I am not on camera. And I would like, before we dig into the good content, I would like to reiterate the support for Lori and I know, like Amy and she has young children and is constantly on the road digging up incredible content. So she is more deserving than anyone I know for the vote. So speaking of that content, let's discuss some of the stuff coming up in your and Amy's meetings and just our overall conversation on the market. I'd say over the past few weeks, the market has once again gotten very concentrated, specifically semis and AI trades. You've seen some volatility in the software growth sector, and that has pushed the market to be even more concentrated if that's possible. So question for both of you on this, as I know you've both done work on this and have had a lot of conversations. First for you, Lori, I guess just generally, do you think market concentration is unhealthy? And in your conversations with investors, is there a lot of angst around this?
It's a great question, Ben, and I will say easily this concentration issue has been probably the number one topic in meetings in 2024. Maybe it's died down a little bit in my conversations than we saw back at sort of the end of the first quarter, but it's still pretty prevalent. The question of whether or not it's unhealthy, I think there was a view that it was. There was a lot of skepticism around, the idea that the market could possibly, keep pushing forward, but we were hearing that 6 months ago. Look, and we're still doing pretty well. As I've looked back at the data, I don't think there's anything unhealthy about concentration in and of itself. If we look back historically, it tends to happen when markets are nervous, these big spikes in concentration, and sometimes it's before a big problem in the market, sometimes it's during, and sometimes it's after. And if you look at valuations, there has been a big gap that's developed between the so-called Mag 7 and the rest of the market. I prefer to actually look at the top 10. You're trading at around a 25 times PE multiple, and that's down a little bit from 28. And guess what? 28, at least on the median PE, was the pre-COVID high. So we're bumping up against that. The rest of the market's around 16 times. I think that's exciting. I don't think that's unhealthy. I think we had a near miss on recession in 2022. And when you come off those kinds of environments, one thing usually runs harder than the other thing, and then the other thing needs to catch up. And so the debate is whether the rest of this stuff needs to catch up. And if you look at earnings growth dynamics, the top cohort deserved to get that multiple based on the premium earnings growth that it's achieved in recent years. I don't think that's anything unhealthy about it at all. I think that's the polar opposite of what we saw back in the 2000s. So I think, that this unhealthy, kind of dynamic, I just really don't like that term because I think this has all been very, very rational and Darwinistic. And now that some of these companies are losing their earnings growth advantage or seeing that diminish, they're getting thrown out of the bucket and investors are starting to look at other things.
Makes sense. And Amy, just from your angle from the derivatives market, I feel like since 2021, when we had this kind of kickoff of this Mag 7 concentration and the winner take all kind of market dynamic, you've been following the skew dynamic and what that means for equities. So maybe just give like a brief history of how this skew has developed. Why should equity investors, who will probably be the majority of the people listening here, why should they care about the skew and what is it telling us right now?
Sure. So first, I like your shirt. And I've been on the road with Lori to many countries and many cities. And I'm constantly in awe of her passion for the markets and her photographic knowledge of financial history. So I too must make my II plug here. But look, I have covered the derivatives markets for 20 years, and to me, the post-COVID volatility regime really is its own creature. As Ben said, skew is something that we constantly look at in our markets. But just to define what that means, it's simply this idea that for most of financial history, put options, so you're buying downside protection, that tends to be more expensive than your call options. And that kind of naturally and intuitively makes sense because most folks are long the stock market and they need to hedge. And you saw skew start to appear in 1987, and it didn't really go away except when we hit COVID. And we had a new skew, which is essentially this focus on the right tail of the market. Folks were far, far more concerned about the right tail grab. And we saw that in momentum. We saw that in FOMO. These are things that, we throw around as catchphrases, but you actually see numerical evidence of that in the options market. And what I would tell you is it's doing two things. So Lori says, look, it's not unhealthy, but it is doing two things to the volatility market. The first is it's making correlation levels look very low. And the second thing it's doing is it can also make volatility levels on the index level look artificially suppressed. And so there are these violent rotations that may be occurring underneath the surface, but it looks very calm on top. And so we kind of call that the paddling duck market, but it's essentially to say there actually is a lot more concern than you may be seeing from headline numbers like the VIX.
Thanks, Amy. And just a follow-up question, Lori. So I know you don't think it's unhealthy necessarily, but obviously everyone, the majority of the investor base, can't own the Mag 7 stocks, whether they're a small and mid-cap investor or even a large-cap investor. So the question we get a lot, obviously, is still what it's going to take for the market to broaden out again, what it's going to take to see that rotation again. I know your love is small cap, so it's a question near and dear to your heart. But what do you think it is? Do you think it's as simple as this waiting for the Godot Fed cut that we've been waiting for so long is finally going to happen? Or until we wait for that, if it ever comes, is there anything else that can act as a catalyst for you?
So I think it's a great question, and we've gotten some hints of it, right? Because we've started to see the big mega cap growth, again, Mag 7, top 5, top 10, whatever it is. We've had some wobbles, right? It's fighting back as we're taping this podcast, but we've seen some wobbles. So what have generated those wobbles, and what's generated this bounce back? One thing that I've noticed that's a little bit weird in the data is that post-SVB, post that regional banking crisis, we've seen this really, really odd trading relationship develop such that when 10-year Treasury yields are rising, the top 5 names in the broad market, in the S&P, the top 10 names, if you look at them relative to the rest of the market, that relative performance trade is just moving in sync with 10-year Treasury yields. So we've seen a little bit of a lift in interest rates recently that's come alongside another bout of, hey, guess what? We're not getting those Fed cuts nearly as soon as we thought we were. And so that seems to have reinvigorated the growth trade. I think part of it is that part of the market has just much safer balance sheets. I think part of it is a reflection of growth fears down the road. But I do think at the end of the day, you do need to get closer to the cuts, right? And we at least need this 10-year Treasury yield pressure to come off. We can't really be in a rising rate environment for the rotation trade to work. I think the other thing that needs to happen is that we've got to get some economic excitement back, and that seems to have really stalled. But the initial bout of rotation that we saw really came on the heels of this rapid reacceleration of 2024 economic growth expectations. So consensus GDP for this year, for 2024, if I looked at it last summer, it was tracking at 0.6%, so barely positive. Fast forward to January, 1.3. Then move to where we are today, 2.4. That's right on the cusp of average. Average is about 2.6. And historically, when you're above average in GDP, that's when value, cyclical, and small cap outperform. If you're below average, you're sort of stuck in economic purgatory. That's when growth, mega cap, large cap, secular, defensives tend to outperform. And we're stuck right on the cusp of it. We made a ton of progress that helped get the rotation trade going, but it just couldn't continue as we stalled. The other thing we've seen recently is there's just been this whiplash in terms of earnings growth enthusiasm for those big names versus the rest of the market. Throughout all last year, more upward revisions for the top 10 names in the S&P or big cap growth stocks in the rest of the market. We got to this last reporting season, all of a sudden the rest of the market started to see upward revisions. There was a little bit of rationalization and catch up. That lasted until we got to retail reporting season when all of a sudden, and we had some of these AI-related names report, you got more upward revisions to earnings forecasts, again, in that kind of biggest mega cap growth cohort. So we've just seen it go back and forth, and that earnings growth dynamic seems to be dictating which part of the market is doing better. Again, it's very rational, but we basically just need the earnings growth expectations in the rest of the market to get going again, and I do think it's dependent upon economic expectations getting reinvigorated again.
Yeah, unfortunately, it seems like this week has been a growth slowdown week with the ISM. We had jolts today, so looks like that's maybe on delay a little bit again until we get more clarity. Just switching gears, another obviously recent topic that I know is near and dear to your heart is the retail investor, the meme craze. We'll leave the specific meme stuff out of it, but it is important. The retail investor dynamic has become more of a feature since COVID, and I think we're all been surprised that how much they've stuck around. I think post-COVID with the stimulus, or the stimmies as they like to say, made sense as to why retail activity was so elevated, but it just doesn't seem to go away. And now just the economic environment just doesn't really make sense of why there's such a feature. I mean, some of the stats that we get from our traders in terms of the amount of the percentage of retail, the volume that's being traded is from retail is quite astounding. So what do you make of this, and what does it mean for the broader market? Why should institutional investors care about retail?
When the first meme frenzy came about, I remember the conversations we were having with institutional investors was just that this was kind of a storm in a tea kettle, something to kind of not pay attention to. But what happened was it wasn't the individual stocks that were problematic. Obviously, if you're not long or short the individual stocks, then arguably, in theory, you don't have to care. But they became larger and larger percentages of different benchmarks. And so I would have these conversations with investors who initially would be like, whatever, it doesn't matter. But then they would start to drag their benchmark because these stocks became such enormous components of them and they didn't have them in their portfolio. And what's interesting is when you think about the AI craze, right? This is actually exactly the same thing that's happening on a larger scale. So this time around, I'd say for institutional investors, they're paying attention to two things. The first is they're looking at more right tail hedging for their benchmarks. What do I mean by that? So even if they're not necessarily long these individual names that are part of the meme frenzy, they are very concerned about their growth within the benchmark itself and that drag I mentioned. So they're doing more of these right tail hedges that we've seen, which are call options on certain benchmarks. And the second thing I would say is this is still a very strong sentiment indicator. So retail demand in call options themselves, which are my favorite words, skew inversion, when that call demand starts to outweigh that put demand, has actually been a pretty decent leading indicator to where we are in terms of froth in the market. And that hasn't changed. It's just actually expanded to different stocks. And so while we initially saw it most severely in meme stocks, it actually applies to a lot of different stocks as well.
Lori, before we jump away from the retail topic, I know a big indicator for you is the AAII sentiment survey, which represents individual investors' sentiment. I know that's a big guiding post for you. So where are we in that right now? Is it too bullish, too bearish, somewhere in the middle?
So you're right. It's something we've used over the last, I would say, really year and a half. I've used it my whole career, but it's really been helpful the last year and a half at navigating sort of these short-term moves, bottoms and tops. And right now, it's getting really, really close to where it was to start the year and where it kind of hovered until we got that 5% drawdown. It's really close to where it was late July, early August, before we got that 10% drop in the market. And look, I think sentiment isn't the worst it's ever been, right? If you're looking at this, it's been hovering just below one standard deviation above the long-term average. And in August and to start the year, it kind of hit that plus one standard deviation mark. And that's typically, a prepare for a short-term drawdown type signal. So that's kind of where we are. I just don't think sentiment got washed out enough with that 5% drawdown that we saw. So our target's 5,300 on the S&P at the end of the year. As I've been running around the country talking to investors the last month or so, the phrase that just keeps coming to mind is stuck in neutral, and I can't make the math work beyond the 5,300 target. A lot of that is our valuation work. We don't have to go into that here, but our sentiment readings are contributing to that as well. And if you look at the CFTC data, which is data that I steal from Amy's team, that net positioning data on U.S. equity futures ownership, it's even more frightening. I mean, it's up above what we saw in January 2018. It's up above what we saw in February 2020 pre-COVID, and it's also above the highs of the 2021-2022 timeframe. So it's, giving you arguably an even worse signal from the institutional side.
Yep, makes sense. Seemed even more concentrated into one sector now as well, given the kind of semi-ownership I've seen as well. So finally, since we are at the RBC Global Energy, Power, and Infrastructure Conference, which, by the way, is record attendance, I would also like to make a plug for our all-star global energy team and institutional investor. It truly is a flagship and amazing conference that you should come to next year if you are not here. But since we are here, we just love the both of you. I know have done work on the energy and utility sector, so I would just love your view on the energy sector, Lori, specifically maybe geared towards utilities, which has come up as kind of a sneaky AI play with just the data center build out. I'm wondering if you're hearing more from generalists that want more exposure to the sector, and then I'll pass along to Amy, which I have a.
Yeah, so it's a great question, and I ducked into an AI panel for our utilities analyst had put together today, and it was packed. There was standing room only. I didn't end up staying because there was nowhere to sit and really even stand. And I can't remember the last time I saw a utility presentation that was standing room only. So I think that's a testament to the investor interest in the utility space right now, just based on, again, on this idea, as you mentioned, of it being a derivative play on AI. And I know I was out marketing a few weeks back when all the utility companies were reporting, and I first started hearing about it, from clients, and they were really just buzzing about how on all these earnings calls, the utility companies were talking about the boost from AI demand. And it contrasted with what we heard early in the reporting season when all the financial services companies were coming out and saying, hey, we're working on this, but it's going to take a few years for it to hit the expense line. So it was a great, sort of illustration how the AI theme is alive and well in investors' minds, but it's not static, right? I mean, people are constantly looking for new ways to play this theme. And I think if you want to trace that back to the utility sector, we had seen nice valuation profile develop for this sector. So this is one that I think I was market weight most of last year. I put an overweight on back in January. I will tell you, AI was not on my bingo card for this sector, but we did notice that the valuation profile had just improved. We were concerned about some chop in the market. We like the defensive profile. It's one that should, in theory, benefit from a rotation to value, just given its presence in those benchmarks. And our analysts have been reasonably constructive. So I think the AI development just came along at a good time when there was, some undervaluation to be exploited. And the market did what it always did, sniffed out the story, reacted, and came in and bid it up. So we're still overweight there. We still like the sector. We have noticed that if you look at sector flows, and we use the EPFR data and look across all the major sectors, utilities has gone from being very negative to slightly positive in a hurry. It doesn't look, overextended to me, but it has been interesting just to watch how quickly that money has shifted. If you think about energy, I know this is a sector that had a nice move earlier this year. It's stalled out a little bit recently in terms of relative performance. On all my metrics, it still looks pretty good. And again, I'm a little bit more long-term with the sector calls, but I still see nice valuations, improving earnings revision trends. Geopolitical angst, I think, is something that we're not going to say goodbye to anytime soon. If you listen to Halima, who's done some fantastic work just on all the geopolitical conflicts that we've seen emerge around the world. And, this is a little bit more boring, but if you look at the dividend yield of energy, it's very high relative to history, and it's very high relative to other sectors. And we're sitting here at a time, given the move in Treasury yields, that very few stocks in the S&P have a dividend yield in excess of the 10-year Treasury. And going back to the more calm part of retail, but many individual investors do look to yield-oriented stocks to boost their portfolio returns over time. So we still like the energy story. We're not trying to play every twist and turn there, but admittedly, utilities is kind of the more exciting one at the moment.
Amy, I know you had an interesting analysis, your Sharpe ratio analysis, and it was actually an interesting finding for the energy sector in general. So maybe first, before we kind of delve in your findings, and you can, outside of energy, anything you found interesting there, but maybe just a quick tutorial for like why it matters and what it showed for the energy sector.
Sure. So I like to think of the Sharpe ratio in terms of Disney World. So, everyone says you're supposed to take your kid to Disney World, right? But you kind of have to look at that return of like how much that was worth it against what your next best alternative was. And, if mine is just free pool at grandma's, that's a pretty good alternative. And then you also have to consider, you take your kid to Disney World, they miss their nap, and there's tantrums, and then that's your volatility, okay? So your Sharpe ratio is really simply your return of going to Disney World against your next best alternative, adjusted for how much tantrum your child is going to have. It's your expected return over your risk-free rate divided by your volatility. And essentially, when you quantify that across all stocks, that gives you a numerical understanding of risk reward. So reward per unit of risk in the market. And the reason we do this is the one big sea change in the market is that the risk-free rate is a real rate now, right? We had zero interest rates for a really long time. We had negative interest rates in some places. But now if you can get 5% in your money market account, then you better be doing really well on your stock to make you want to do that versus your next best alternative. And so when we look at that quantitatively across sectors, it actually shows that energy is the top sector from a Sharpe ratio perspective when we aggregate all the weights in the energy sector. And that's really interesting to me because, look, as Lori knows, I'm not a fundamental person. We do everything quantitatively and systematically. And so I go by what the data says. And right now, it continues to say that energy is one of the more attractive ones on a Sharpe ratio basis. And we use consensus changing price targets over 12 months as that expected return.
Makes sense. Yeah, it definitely qualitatively seems like the risk reward for the companies presentations that I'm sitting in is certainly positive based on their comments. So that's all I got. See you both on the road sometime in some random Midwestern city, and thank you again for having us.
Well, thank you both for doing this. I've done this podcast or Markets in Motion at least for a few years now, and it's been one of my very nerdy dreams to be able to do a conversational podcast, and I can't think of two better people to do the first one with.
Thank you.
That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions. This episode was recorded on June 4th, 2024 at 4:47 p.m.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.